So how do you make your investing decisions? Do you spend lots of time analysing the company accounts and reading the financial press? Or do you listen to your friend down the road who supposedly has the next hot share tip? Right here, right now, there's no way I can tell you where to invest your money. If I met you and got to know you a bit more, then I definitely could. But until then, there are 3 investor basics that will greatly improve your chances of investment success. So if someone puts me on the spot right now and says, Carl, where should I be investing my money? The only answer I can really give is, it depends. It depends on what's important to you. Before you start investing, you need to know the reasons why you're investing. You need to think deeply about your values and your goals and what you want out of life. If you're in a relationship, make sure you discuss with your partner your values and goals, because there's nothing worse than having different goals and you don't talk about it and you're secretive with money. So because we all have our own unique values and goals, our investment strategy will be different to anyone else's. It's a very personal thing. But once you know your values and your goals, you know how much you need to hit those goals, so you know what level of investment return you need. Then it's a case of working backwards a little bit and working out a proper investment solution that will be able to hit your goals and targets at a level of risk that you're comfortable and able to take. So these steps that I've just described are the first sort of steps that you'll go through with a really good financial planner in the first or second meeting. And sometimes this is where a good financial planner can really help, because it's very difficult to quiz yourself and be unbiased and to challenge yourself. But a good financial planner will be able to delve with you deep into your values and goals so you really understand what they are. So once you understand why you're investing and you've worked out your goals and targets, there are 3 basics for investing. So number 1, diversify your investment portfolio. So this really is, don't have all your eggs in one basket. Spread your risk. So basically you can diversify your portfolio into different types of investments. So you could have stocks and shares, you can invest in property, cash, bonds. You can also diversify across different countries. So you can have shares in the UK, shares in America, Europe, China. And you can also diversify across different sectors of the economy. So perhaps technology, banking, oil. All of this is diversification. So if one area or one different investment goes down, another area might go up. So this is spreading your risk. Really important. Number 2, keep your costs low. High costs for investing are seriously damaging to your wealth. When you come to make an investment, there's usually 3 ongoing fees you'll usually pay. The first is to the investment manager, the fund manager who's managing your money and in choosing which companies to invest in. The second is to the platform where your money is actually held and administered. And thirdly, if you use one, you may pay a fee to a financial advisor or a financial planner. Ideally, you want to get all these costs under 1% per year of the value you're investing. Anything higher, then that's getting a bit too high cost. There's lots of evidence out there that shows that active investment managers who charge more because they believe they can outperform the general stock market fail to do so once you factor in their extra charges. So you may find you're much better off going for passive tracker investment funds that just track the general investment market at much lower cost. And number 3, risk and reward. You need to understand that risk and reward, when it comes to investing, go hand in hand. You can't have one without the other. In order to achieve higher returns on your investment, you need to take higher risk. But obviously, to get those higher returns, you are going to be taking higher risks, so it could quite easily go the other way. You see, the stock market generally goes in cycles. Every now and then there's always going to be a stock market crash. So your portfolio, your investment portfolio, needs to be prepared for that, and you need to go into the world of investing on the basis that at some point your fund and your investment value is going to go down significantly. But over the longer term, the great companies of the world recover and generally go on to bigger and better things. So risk and reward do go hand in hand. But if you follow the first two rules of thumb that I explained earlier, you can kind of get the best of both worlds. Higher returns, but for much less risk because you've diversified and kept your costs low. Successful investing should be really, really simple. Build the right portfolio that is aligned to your goals and values, and then let it do its job. Don't keep checking it. Don't keep making changes, especially when the stock market crashes. Don't lose your head when everyone else is losing theirs. And if you don't trust yourself to do this, find a good chartered financial planner who can help you.